Welcome to Kitco's premier live interview with Gary Wagner, editor of thegoldforecast.com. I'm David Lin. Today we'll be talking to Gary about his economic forecast and also his outlook for gold, silver, and other investments that he would like to invest in and pay attention to in 2021. Gary, I'm so honored to finally have this discussion with you. You and I have spoken several times on the show. We've talked about doing a live webcast. Here we are, finally. How do you feel?
I feel honored to be part of the first live webinar with Kitco. I think that the viewers will be able to glean some important information out of the next 45 minutes or hour that will aid them in their investment decision going into 2021. So it's quite an honor to be here.
Well, it's an honor to have you, Gary. You're a fantastic technical analyst, and you've got great thoughts on the macroeconomic landscape. If you're watching this right now and if you're just tuning in, please be mindful that there is a comment section. Write your comments and your questions down below. We will address them as they come in. There will be a Q&A question at the end of the session, but throughout the interview, we'll be taking questions as they come in. Gary, I know we've spoken about price action a lot, about gold, short-term action. Today, we're going to talk about that as well as your longer-term outlook. You've prepared for us a great presentation about your longer-term cycles and the technical indicators you're looking at. Before we get into that, give us your outlook on the economy first. 2020 has been a tough year. We're near the end of the year. Can we see a recovery? That's what economists and investors alike are wondering.
Well, I think that we will see, first of all, gold move higher in 2021. However, we could see some pressure before it really hits a corrective bottom and then begin to move higher. What I find interesting about what we're witnessing today, we've got gold down about $18. And it's one day after they actually finally passed a $900 billion fiscal stimulus bill. And the fact that we've got gold selling off, I believe, is going on two fronts. The first real issue is I think we have a little bit of buy the rumor, sell the fact. So the announcement has been made, but then we had a wild card come into the market, which was a variation of the coronavirus, which of course is the virus behind the COVID-19 pandemic, surface in London. And that of course creates fears that there will be more lockdowns in Europe. We will have a continuation of a slowing economy both in the United States, Canada, as well as Europe. And they're not sure how the vaccine, how effective it will be against this variant. And I think that that is genuinely brought some fear into the market. And that is the reflection we're seeing when we look at gold pricing being down the day after fiscal stimulus was passed. I believe for the most part, they had factored in that they would pass something prior to the end of the year. It really was a necessity when you consider the fact that on the day after Christmas, unemployment benefits for those 12 million in America that are not able to find work were set to run out, the extended benefits. And then even more detrimental, potentially detrimental, is the fact that on December 31st, the eviction or the moratorium on evictions was set to end. Now, one of the things that this bill did is they carried the moratorium another month, so it's now good till, I believe, January 31st. And secondly, they've reinstated the extra $300 of additional benefits to those that are unemployed.
Okay.
And so those are the macro environment that we are currently in, David.
Gary, a few questions have come in already before we get into your presentation. I'd like to address some of these questions first. This is a fair point. Stimulus is in, but gold is down today. You've briefly addressed this just now, but I think investors are curious as to why stimulus is not having a positive effect on the metals. Should we be giving up on stimulus as a tailwind? Should we be looking at something else, Gary?
Well, first of all, I think that the overall belief is that the stimulus bill that was passed, which is $900 billion, it's a sizable amount. There's a belief that once Biden gets into office, they will need additional stimulus to really revitalize the economy and to shore up those people that are genuinely experiencing hardship, whether it's work and not having it, whether it's a home and not being able to pay rent. So I think that what we're seeing first, as I said, was buy the rumor, sell the fact. And the other variable is the fact that a day before they passed it, a variation off of the coronavirus has now surfaced in London. And I believe there was even a case in Saskatchewan, Canada. And so the question is, how effective will the vaccines that are now being administered be for that mutation or variation off of the virus?
Okay, this question sets us up for the rest of your presentation. We'll talk about asset allocation in a bit more detail towards the end of the presentation, but this is a good one. Say you have 10K to your name, Gary. What would you do with it? Would you get out of the stock market, or would you stay in mining stocks only? So I think this ties into your thesis about investments and the economy. What sectors do you like right now besides gold and the precious metals, Gary?
Well, I do have to start with the precious metals, because I believe that if you have a portfolio of, let's just say the full portfolio is 10,000.
Yeah.
I believe it's critically important that you allocate between 5 and 7%, up to 10% into the physical ownership of gold or silver, kind of as a safety net. I believe that fact is as true now as it was a year ago or 10 years ago, that you should have a small percentage into that hard asset. It does protect you against inflation, and it does have the ability, typically when equities are moving lower, you'll get gold moving higher, except for a few instances that we've talked about in the past, which is when the Federal Reserve is aggressively doing quantitative easing, and most importantly, having an extremely accommodative monetary policy. You know, Jerome Powell just came out, I believe about a week ago, and when he spoke, he said that they have planned to keep interest rates between 0 and 25 basis points, which is 0.25%, at least through 2021 and 22, and they wouldn't even think about raising it till 23. So you're in an environment where money is cheap, so to speak.
Okay.
And when that's the case, one of the things you might want to look at are some of the financials, the banking sector, which has been under so much pressure. When they're able to borrow money at such a low rate, it's easy for them to loan it out and get the spread that they want. In terms of other investments that I like, I believe that a 3 to 5% allocation into Bitcoin, and that's been on fire, is warranted. Realize that that will probably be the highest risk asset that you hold in your portfolio, but it has just broken through 20,000. I believe it's up to 22 or 23,000 now.
Yeah.
And although I had difficulty when the pundits out there said it was going to go to 40 or 50, and there's ungodly numbers as high as people have called
Sure.
Bitcoin to go to.
$1 million even?
Yeah, I think that it's realistic for it to go to 25 or 30,000 based on the fact that it hit 20, it dropped like a rock. We follow BTC, which is the Chicago Mercantile's Bitcoin futures contract, and it's a 5-point contract. It does contain leverage. There's also Grayscale as another vehicle to invest in it. And then there's the cash market itself, whether it's Coinbase or other things. But I think that that's something you want to look at. I have always liked Tesla, but I am flat on Tesla right now, because once it joined the Standard & Poor's, which occurred yesterday, we've seen some real selling pressure come into that particular equity. I think long-term it's a great bet, but I think you'll be able to buy it a little less expensive than current price.
We haven't talked about Bitcoin a lot, you and I. We've focused mainly on the precious metals and other stocks, but Bitcoin's an interesting topic. I know that you're somewhat bullish on it now, but do you see more upside in 2021 for Bitcoin than gold, perhaps? Which do you think has more growth potential with XR?
You know, well, the potential has got to be Bitcoin. It has been outperforming both percentage gains in gold and silver as they've moved up. It's going to be much more volatile. In terms of our technical studies on Bitcoin, we're at a pretty critical point. If it does begin to retrace, we want to look at the level at 19,000 per coin as a critical area. If it holds that area, we believe it could go to the next level higher. If it does not, we believe it'll drop to the next level lower, which I believe is around 17,000. but overall, Bitcoin is really the highest potential in terms of potential gains this year, but also realize there is no reward without risk.
Yes.
And so intrinsically, there's a lot of risk in Bitcoin investing.
You've been trading for decades. This question came in. You've been trading for decades. Do you remember any other period in your career where extreme volatilities in gold and silver have been in the markets as we've seen this year, Gary?
Absolutely. I began my journey in 1984 as a RR, a registered rep or a commodity broker. A few years later, I realized that I didn't feel good about taking a trade and making a commission if the client lost. So I became a CTA, which is a commodity trading advisor. So simply put, I would take a percentage of their profits on a 6-month basis if my trade calls were successful, and I would be paid nada if it didn't yield a profit for them. So I felt very comfortable doing that. But from there, I really moved into system development because I was exposed to candlesticks in the early 90s, 91 and 92, and I found them to be an extremely revealing way to look at price data on a chart. The interesting thing is it uses the same 4 data points, open, low, high, and close, but it is reflective in terms of the linguistics of how the Eastern trader views the market. We'll talk about that when we cover the differences, but it has some unique insight that, simply put, is not available when you look at a bar chart.
Okay, this final question I'll take before we get into the educational segment of your methodology, it's that, well, now that the stimulus has passed, there's been very little reaction to the metals markets. What could possibly make gold go higher? Or I guess the reverse of that question is what could make gold go lower? So what could move gold if stimulus doesn't have the desired effect? Gary, that leads into your methodology and what other indicators you're looking at. Well, before we talk about your methodology, can you briefly answer that question? What are the top indicators you're looking for that could move gold in 2021?
Well, the key factors are going to be a monetary policy of the Federal Reserve. And they're already extremely accommodative and have vowed to keep it that way for quite some time. Because the question that came before that I didn't finish answering, have I ever seen these kinds of moves? And the answer is yes, 2009, also 2002, but specifically 2009, when gold reached a high of $1,000 and then went to 700. And from 700, it never looked back until it hit 1900. The reason that it moved as high as it did, as fast as it did, was that was the first time the Federal Reserve actually initiated quantitative easing. We weren't familiar with that terminology prior to the banking crisis that began in 2008. And so it was Fed action then that took gold to an all-time record high. I believe the all-time record high we saw this year at 2,088 reflects a really accommodative monetary policy. Add to that an expenditure of $3 trillion on the CARES Act, and you had the makings, that kind of perfect storm for gold to move to our new all-time high above 2,088. And so that's the last time I experienced really gold move in this way. Now, to answer the question directly, continued accommodative measures by the Federal Reserve coupled with additional stimulus will certainly take gold, I believe, to new all-time record highs in 2021.
Wow. Okay,
those are the key factors.
That's a possibility, new all-time record highs in 2021 for gold. Okay. All right, Gary, we'll revisit that call later on in the interview when we talk about your price forecast. Now, let's move on to your methodology. There are 3 indicators you look at: candlesticks, Fibonacci sequence, and the Elliot Wave Theory. We'll touch on all 3, starting with candlesticks. Are you sure you want to talk about these things, Gary? I thought a magician never reveals his secrets.
Well, you know, this is a secret that has been around since the 1600s, when the first futures exchange opened. That's the Dojima Rice Exchange. And there was an individual trader that recognized that there was seasonality to the way markets move. But more importantly, he recognized the fact that the price of a given commodity, and at that point it was rice, that was the single greatest asset in Japan. The samurai were paid with bags of rice. That was the commodity or monetary unit of the time. But he realized that the reflection of where the price was and where it should have been, the differential was market sentiment. He realized that there was a component of pricing that is how people feel a commodity, and we'll take, for example, gold, will move in the future. And so if they have extremely bullish market sentiments, they will bid it up in advance of that value actually catching up to it. The reason that I started with candlesticks is in 1983 and 84, as a broker, I was classically trained in the theory of Western technical indicators, things like moving averages, stochastics, the MACD. And what I found is that for the most part, all of these technical indicators were lagging indicators. And what I mean by that is they tell you a move after it's already occurred. A moving average has to lag behind because intrinsically it's an average based on X amount of candles that have already occurred. And I began to watch one of my clients who had an incredible results in terms of he had 8 trades in a row correctly, but what was most impressive to me is the fact that I remember this with oil specifically. Oil was running up past $100. I think it went to a high of about 132. And as it hit the top and the market was overwhelmingly bullish, they were calling for 150 and 160 a barrel. He called me up and said, Gary, sell oil at the market. His name was David M., and he was an engineer for General Electric on the East Coast. And I said, David, are you sure you want to place this order? I mean, everybody's so bullish. Gary, place the order and I'll explain later. So I did, and sure enough, the very next day, the market dropped and dropped hard. He was able to find that pivot or key reversal point before any of my other clients and the trading public at large saw it. And I asked him, I said, how can you be so accurate? You've hit 8 out of 8 trades. You're calling tops, you're calling bottoms. How are you able to actually achieve these results? And he said, I can't explain it to you, but I'm going to send you a book that will.
Okay.
And he sent me out a book by Seiko Shimuzi called The Japanese Chart of Charts. It was the first time that a Eastern trader, a Japanese trader, had his technique translated into English, and it became the foundation for Steve Nissan, who wrote some of the primary books on candlesticks, Greg Morris, along with the book that I wrote in 1993. And what I realized is that candlesticks are unique in that the patterns that they were able to identify are able to quantify market sentiment. And that statement alone is an incredible accomplishment, to be able to put a mathematical number or a pattern that you can recognize, which means that the market might pivot. It will reverse at this point. And the Japanese were the first ones to do that.
Okay, Gary, let's put this theory to real life example now. Can you pull up a gold chart and talk about some of the recent price bars that we're seeing, and you can talk about the candlesticks there with a real life example?
The first thing that I want to do is basically pull up a split chart. You have Bitcoin, let me get back to our gold. But the chart that I'm going to pull up is going to be a gold chart on the top and a gold chart on the bottom. And the difference is one is in bar chart format and one is in candlestick format. And what you'll realize about the difference between creating these is a simple bar chart has a vertical line, and that vertical line, of course, represents the high and the low, and a little horizontal hashtag on the left-hand side. And what that is referring to is where the market opens, and this is where the market closes. And you can see that as we move up on our bar chart on the bottom, that it gives you these Greek, I've color-coded it so an update will come in green. But simply put, all the Japanese do is they put their emphasis in a slightly different way than the Western trader does. And so in essence, what they do is they believe that the most important detail about a daily move in the market is not the close-to-close relationship, but rather where a market opens and where a market closes. So that when you look at these green candles, such as the one I'm highlighting right now, you can see that it opened near the low. It made a higher high than the close, but the top of this green rectangle represents the closing price. And so when you get a scenario in which the marketplace has been dominated by the bullish faction, so to speak, that means that they're in control of price changes that day. And what tends to happen is when you have the bullish faction able to do that, you get these long green lines. It simply means that the market closed above the open.
So what's happening today, Gary? Some people are asking the same question, like what's going on today? Are we seeing more of a bullish pattern or a bearish pattern? Which camp is dominating today?
Well, take a look at the candles that I've just circled. And so what we had is a very short-term defined uptrend. Then you had yesterday's action, which is a green candle, which means that it was dominated by the bullish faction. However, today you have a small body candle that falls within the body of the green candle. This is simply called a bearish harami. Harami simply means pregnant in Japanese, and what it refers to, the Western traders simply call it a inside trading day. And so what you look for of all of the key reversal patterns, that is the least effective in terms of it having reliability, but you take this as a sell signal if in fact the following day, which meaning tomorrow's trading activity, would be a red candle, meaning it opened and then closed lower with a lower high and a lower low than the previous day. If we get that, I think that we'll see further downside in the market. If we have an update, it just invalidates the actual call of the bearish harami. That's what we see there.
Okay. Before we move on to the other indicators you're looking at, let me just recap some of these questions that have come in. We'll address all of them later on. So there's a couple great questions about silver, the US dollar, and his relationship with gold. So we'll talk about all of those things in just a minute. Gary, let's recap your thesis so far. So for those of you who are just tuning in, Gary Wagner is the editor of thegoldforecast.com. He is calling for gold to potentially reach new highs in 2021. Bitcoin is also an asset that he likes. New highs again for Bitcoin, potentially to outperform gold as the cryptocurrency has more upside. Gary is now walking us through his methodologies for identifying trends. We've already covered the Japanese candlestick chart reading method. Now we're going to talk about the Fibonacci sequence. If I understand correctly, Gary, the Fibonacci sequence is more for a medium-term sort of forecasting tool?
Well, what you'll realize of the three techniques that I have utilized together, I call it the new technical triad, they are all leading indicators. So what Fibonacci retracement as well as extensions allow us to do, let's say that gold moves from $1,000 to $1,500, and that's a $500 move. And then we recognize a candlestick pattern that's a pivot, meaning it's probably going to sell off. We need a way to determine where that correction could end. And that's where we use Fibonacci retracement. But I think before we get to that, what I want to do is simply show you, this is what the marketplace looks like on a daily chart. Excuse me, this is a weekly chart, I apologize, of gold, but it has no patterns that are specifically identified. And so what I've done here on this next chart is you can see that we do have a daily chart, and we've identified some key patterns that are important because they tell us of a potential pivot. I draw your attention to this top that came in the beginning of August. This, of course, occurred when gold ran from what, about 1450 at the middle of March all the way up to 2088. In engulfing bearish, it's simply a two-day pattern in which the first criteria is it has to occur following an uptrend. So we met that criteria. you get a large green candle, which is here. And then on the following day, it opens above the body of the green candle and closes below. In other words, it totally engulfs it. To take that call, you would get a confirming candle, which would be a red candle with a lower low and a lower high. You can see that this, for example, is a buy signal. It's a piercing line. This is a bullish Harami, kind of like the one that we identified in our weekly chart, a three-river morning star here and tower bottoms here. So, for example, when we have this, what I found with candlesticks is although they are able to very accurately give us pivots or key reversal indicators, some signals, some patterns occur and they're stronger than others. So there has to be another way really to go and filter that. So what I've done is, in addition to basically looking at the candlestick patterns, you can see the chart that I've just pulled up incorporates the same patterns we just have. And then what I can do is I can go ahead and do a basic Fibonacci retracement. So in this case, I'm looking at a rally that began in March and concluded in August, and it really took gold substantially higher. Now, we know that it's going to correct. So where do we look for that correction to conclude? Typically, the points that you want to look at are going to be the 38% retracement or the 50% retracement or the 0.618%.
Okay, I don't mean to interrupt, but just on that point, 38% retracement, 50% retracement, how likely is that to happen from today's levels, Gary?
Well, what we're seeing is this. If you look at the correction itself, it concluded at the 50%. So
okay,
we're still looking at historical history. We will tell you why we believe that gold will be higher, but what we're going to do is utilize a Fibonacci extension rather than a retracement. We use a retracement if the market's been in a downtrend. How high will it move up before it then goes back into a bear mode? And that would be what's called a bearish count. This we're using as a bullish count. So the one thing that I'd like in terms of a takeaway for our viewers to understand is when you find these particular patterns occurring at key levels, Fibonacci levels, it adds weight to the probability that the candlestick pattern that you've identified is actually giving you correct information and tradable information. And that's what's so important.
All right, I see a bunch of questions, great questions about the dollar. I'm not ignoring these questions. We're going to address the dollar right after this portion of the interview. Let's finish up the technical indicators, Gary. So I want to know what the upside for gold is. Give us a Fibonacci extension to the upside here. What's the potential for gold to go?
Not a problem. The first thing that we have to do, we're one step away from that, but the first thing that we really need to do is to take a look at Elliot Wave, because
Elliot Wave,
what Elliot Wave does is we've got candlesticks, we've got Fibonacci retracement. Now we have to have a way of numbering or looking at the basic ebb and flow of a market. A bullish market, under the belief of R.N. Elliott, will move through a series of steps as it gains value. And he believes that there's 5 impulse waves. And of the 5 impulse waves, you'll be able to subdivide that into a motive phase, which means it moves up, a correction, another motive, that's going to be your 3rd wave, then a correction for your 4th wave, and then a 5th wave. And so what we're looking at when we look at this is as follows. We've got our wave 2 concludes down here at 1450, and from 1450, we have a completion of a 3rd wave on our Elliott wave count. Then the correction that came in really went on to the beginning of December, and you'll see that you've got not only an engulfing bullish, but you have a C and a 4. So that means that you have concluded the 4th wave. That occurred by a series of waves because that retracement had an A, a B, and a C. So that's where that little C comes in. And now this is our 5th wave right in here. So in order to do our forecasting, one of the basic tenets of Elliott Wave is to use wave 3 to forecast where wave 5 will go. And that's going to bring us to where we believe it could go to by the end of the year. And to simply do that, we're going to pull up our last chart that does just that. And what we're looking at, you'll notice I've just duplicated the chart and added one more facet to it. But here, excuse me, but here, what we want to look at is first the move that was made for wave 3. So you go from here to here, and you're basically counting the range. And then you begin your extension from the conclusion of the correction. You can see that down here at 1770, call it. And the basic rule of thumb is that to forecast a fifth wave, you want to do a 0.618% extension of wave 3. And so when we do that, you can see this number that came in right here at 2163. That is what we are forecasting gold will go to at the conclusion of this fifth wave. Now realize that the fifth wave that we're currently in is not going to be a straight parabolic line up, but rather it's going to be a wave 1, a wave 2, a wave 3, a wave 4, and then a wave 5. So that when we look at what's happening here, this could be the conclusion of this first component, our wave 1, and then we'll get a correction, which will take us typically either to 0.618%, 50%, or 38%. And to answer the question of which one is the valid one, you look at, though, if gold continues to go lower, you look to see how it reacts when it hits these various levels. And so right now, I believe we're here in the larger picture. In other words, we're probably experiencing a wave 2 correction. That's going to be followed by the longest of the impulse waves, which is wave 3. Then we'll get a 4. By the time we get to our fifth wave, we will go either to, I'll call it 2160, and I'm just simply rounding it off.
Yeah.
And you can go as high as 75 or 78%, but what you cannot do is do what's called a 1.1%. In other words, wave 5 cannot be bigger than wave 3. So the top of this chart says 2320, call it 2300 would be the upper limits of where this method forecasts gold going to, but more realistically, 2160 to 2248. And how we achieve these results is exactly the steps that I have just talked about. In other words, we have candlestick patterns. We use Fibonacci retracement to look at various levels where it could find a key reversal or pivot. The pattern itself is going to tell us if pivots occurred, and then we use Fibonacci extensions to forecast where we believe it will go.
Okay, so I guess that answers the question, which is where we're going next for gold. If I understand correctly, just to sum up, we're currently in the second wave, Gary, which means we're headed for more price corrections in the short term before that impulse wave goes up. So what's your year-end forecast, Gary? Is it down or up?
You know, the year-end is, the one thing is that at any given point, short term, there is noise in the market, and it's much harder to predict where it's going to go in the next 2 weeks.
Okay.
If I had to, though, if I'm pushed to do it, if we see continued weakness, we've now been down for, we've had 2 red days. And so what I would look for is how it reacts at about 1840. And I would specifically tune into about 1760, which is the bottom of this fourth. It really can't go below this starting point. So we could go as low as, say, 1800, 1830, 1840. But where's it going to go by the end of the year? Typically, we then would look at seasonality. And typically what we see is that gold tends to rally either towards the end of a year, going into the next fiscal year, or at the beginning of the next year.
Yeah.
Over the last couple of years, we've had rallies. I called them a Christmas rally. We had rallies that really began right around the end of December and took us through February.
That's one of the questions. It's a good question. Why aren't we seeing that rally now? It's the end of the year.
Well, again, you have to understand that as precise as technical indicators are, all they are is a distillation of fundamental events into numbers. And the reason I was drawn to technical analysis, and I considered myself a hybrid trader. In other words, I look at the underlying events or fundamental factors that will cause a market to be bullish or bearish.
Sure.
And so there's been a predominant amount of factors that have really caused me to see uptrends in gold. But during those uptrends, it will not be a parabolic rise. You'll have peaks and valleys. So the basic thing that you want to realize is that in 2 weeks, I really wouldn't be able to answer that with any kind of precision other than a guess, and technicians don't like to guess. But what the numbers are telling me is that over the next, say, the first and second quarter of next year, we will go through this 5-wave count to the upside. Of course, my first target really to take out is this high here. That comes in at around 1960. Of course, first we have to make it over 1900, which is approximately here. 1940 is a key number to me. Then above that, we would look at this top here. And this top here, I believe, comes in right at around 2000, just above that. And then the brass ring, of course, is 2088. That's the new all-time record high.
Right.
So it would be a stair-step manner back to higher pricing. And we would look at these key areas, meaning the all-time record high here and various tops, as points in which it made sense to look for a potential pivot or reversal. You would also take into account the different fib numbers. So this one is being highly important to me, which is 1940. That's where I show major resistance currently after we break back above 1900.
Okay, Gary, so that was my next question. The timeline for the 5 cycles. So you're looking at the next 2 quarters to breach 2163?
I would say by the second or third quarter, we should have gone through that 5th wave. However, realize the one thing that all 3 of these methods do not really account for or give you valuable information is time. Because what they're looking at is a rally, and we look for continuation patterns such as 3 white soldiers. And I'll give you an example of a 3 white soldier. It's basically where you have 3 green candles all opening within the body of the prior one, So this here is an example of a continuation, but it doesn't tell us that that's going to end. So what we would look at is, here's your first red candle that comes in here. And when you look at it in that way, you can see there was no follow through. In fact, there was a gap, and that maintained that bullish demeanor, so to speak, up until the engulfing bearish. It also corresponds to the conclusion of wave 3.
Okay.
So that's like a give me a mulligan. I mean, that's telling you loud and clear that you've reached the top.
Fair
now,
enough.
there is one other strategy that I use to really...
Okay, before we get into this other strategy, Gary, this question came in, and it's a very good question. What happens after the 5th wave? Price correction, consolidation? How long can this bull rally continue?
Well, here's the thing. You have an 8-count full cycle, and in fact, let me pull up a little illustration of that for you. But you have a basic count, which basically says that an Elliott wave itself, and we'll go ahead and pull this up and enlarge it. But what we're looking at is basically an Elliott wave count. On a bullish count, the belief is that it will go through a series of 5 waves, and that's what we've been talking about. I'll put this in black.
Okay, so that chart looks like it's going to crash after wave 5.
Not crash. You're going to get a 1, 2, 3, 4, and 5. In a bullish scenario, you will then get a correction. It can occur in different ways. You can get, the most traditional is called a zigzag, where you get an A, a B wave, and then a C wave. Now, the belief is that if the bullish fundamentals that were underlying why the market moved up in the first place here are still in place, this pattern repeats itself. So as long as it's in a bullish cycle, you'll get the first half, which is called the impulse period. And of course, the impulse period is simply these 5 waves. And we'll go ahead and just highlight them, but it's these 5 waves right here. Once that's completed, it will go into a corrective period. Now, the correction, it can appear like this, or it can appear as a pennant formation. In other words, rather than going A, B, C, it goes 1, 2, 3, 4, 5. And you notice that the range compresses. We've seen that occur many times in gold, in which it's a sideways consolidating pattern, but it doesn't go straight down and straight up and straight down. Rather, it channels, and that channel really begins to narrow. And the thought behind this pattern, of course, is when it reaches the apex of the triangle, energy is released, and it will typically break and break hard to the prevalent trend direction. So if the prevalent trend direction is up, as we see here, then the triangle will break to the upside, and that would create a wave 4. If this was 5 and then ABC, it would start all over again.
Can we expect a correction then in third quarter 2021, according to that chart? So you're saying wave 5 will be concluded around the second quarter. What comes after wave 5 is usually a correction, even in a bull market. So
in a bull market, there's always going to be a correction.
Okay.
And the question that you need to ask yourself is, how deep will the correction go?
Yeah.
I'll pull this back up. And to answer that one, simply put, is that what you realize is here's our wave 1. And wave 1 is really your benchmark wave, because you use that to determine where wave 2 will go, where wave 3 will go, and wave 5 will go. And the way you do that is you're going to have 2 corrective waves, the wave 2 and the wave 4. And typically, the models we look at say one of the 2 corrections will be a deep correction. So in this example, this correction is a 0.618% correction of the move of wave 1. That's what would terminate it. So rather than us looking at time, it will change at this particular time. What we look at is the price point, and then of course we do this through Fibonacci retracement. Once it's retraced 61.8%, it's usually a deep correction, and then it will move back to a wave 3 scenario. Now, the way we forecast the wave 3 is, and I've shown you a couple examples, but is wave 3 is typically a 1.618% extension of wave 1. Then wave 2, you're going to utilize the move in 3. And as you can see, this is just one model, but it's a pretty standard model. Here they showed correcting to the 38.2% retracement. And for your 5th wave, you can achieve that using 2 methods. So one method is the method that I showed you. We do a 0.618% extension of 3. The other method is typically wave 1 and wave 5 are about equal of length. So you would do a Fibonacci extension of wave 1. You would start it here, and you would times that by, in other words, if this move here is 300, you would add $300 from the conclusion of the 4th corrective wave.
Okay, thanks, Gary. So we have to move on to the next segment and talk about the dollar and silver now. So before we conclude gold, just in a few sentences, recap the key levels to look for before any of these waves invert.
Okay, and are you talking about gold or
for
silver
gold?
right
for
now?
Gold.
Okay, so basically, let me go ahead and pull this chart back up, and this is going to get to the other technique that we kind of add.
Sure.
You'll notice that the chart we're looking at looks like a candlestick chart, but it's not. It's called a Henkinashi, or Japanese average chart. It has the ability to really take the noise out of the market. And so what happens is the key difference is that a candlestick is created by drawing a rectangle around the opening price and the closing price. If it closes above, it's green. If it closes below, it's red. In a Henkinashi, the open is always fixed as the midpoint of the prior candle. And that's why one of the things that I utilize and I find to be extremely effective is to use that in conjunction with the other techniques that we have just talked about. Take a look at this rally, and this, of course, is the rally to the all-time record high. You have green candles with large body sizes. That's the first thing you want to look at. The second thing you want to look at is that there's an absence of lower wicks. If you notice all the way up here, you never see a lower wick like you do here, for example. And so what that means is that during that trading session, it never traded to or below the midpoint of the prior candle. Now, when you do that, what we look for then is really a pivot. And that's what I want to show you here. So as this market went up, you notice how that there's absolutely no lower wicks pretty much all the way up until this candle right here. And you notice that's the first time we see a lower wick, correct, David?
Yeah, I see it.
Okay. And then
So,
the following candle is a small bodied red candle. That's our pivot. So we saw that there was an engulfing bearish pattern through candlesticks. And then if we convert it to a Henkinashi, we wait for this pivot, meaning a return of a lower wick and the color change from green to red. The other really beautiful thing about using this is when you're in a sideways or a congestion area, sideways trading market, it's characterized by alternating candle color and wicks that are both on the top and the bottom. This tells you that there's no clear trend. And so what happens is you then get this pivot candle that comes in, the small red one, and then you get a small correction. Let me draw that in a little bit better, but you get a small correction. And what you'll notice is that there is an absence of lower wicks, and it's really that absence of higher wicks, and it really is telling you that the downtrend is still got momentum. What the Henkinashi does better than any other chart, it charts the momentum or strength of the trend. So you'll see there's a complete absence of wicks all the way down, and then here you get your pivot candle, and then you go to green. And so that tells you that we're probably going to see a slight uptrend, which we did, but it returned to trading sideways. So this is the tool that I use to confirm the other methods that I use.
okay, perfect. Let's take questions from the audience now. We have about 15 minutes left, and there's a lot of good questions about the markets. The first one, the first line of questioning is about the U.S. dollar. People have been wondering about the dollar. It's up today. The first question is, well, do you know why the dollar is up today? And actually, if you look at the longer-term trend for the last couple of months, the dollar has been trending down. So can we talk about the dollar just from a more fundamental level? Why has the dollar been trending down, and is the dollar going to continue trending down? One of the questions is, can the dollar collapse in 2021? Well, we have to define what the word collapse means. I mean, maybe you have a definition.
Right.
Yeah.
Okay, so the chart that we just put up for our viewers has gold as a line chart in gold and the dollar as a line chart below it in green. And we can definitely make a couple of quick observations. And the first observation is we've seen a definitive downtrend in the dollar beginning, I believe that this is March when it hit these highs at about 103, and it's now tracking to about 90. Our technical studies indicate that the dollar is basically in a free fall, and the next level that we could find support is going to be 88. It's based on a long-term fib study. If it breaks below 88, then you're looking at 75. But even if it goes to 88, you're talking about another 2 to 3% decline in the dollar. Now, typically, when the dollar moves lower, you have gold moving higher.
Yeah.
And we can see that correlation right here. However, here you have gold moving lower and the dollar moving lower simultaneously.
That was one of the questions from the audience. A great point. You know, when we had gold at 2K, the dollar was much higher. Now gold's, now the dollar is much lower than it was earlier in the summer, yet gold has only fallen from its summer high. So what's going on there?
Well, you still have the safe haven aspect to gold, but typically when you see the dollar and gold both track lower, you've got something probably occurred right around this point, or maybe even this apex here, in which the stock market began to trade under pressure. Because what happens is, even though you would think there would be a rush to gold, you get this fear factor or mass liquidation of all assets to pay for margin calls, to stream up in cash. The dollar is a different story though, because really what you want to acknowledge about the dollar is as long as the Fed is doing quantitative easing, and that's what we're looking at right here. It's the same thing we were looking at when the dollar fell during 2008. This is the dollar devaluating because A, the Treasury Department added $3 trillion worth of debt to the budget deficit. So it has to intrinsically take the dollar lower, because if you have more dollars in circulation, it's kind of like adding shares in a equity. You dilute the individual value of each share if you add more shares to the pool, right? Well, when you add more dollars to the pool, then what you have is a scenario in which you're diluting the value of the dollar. And that's what we're witnessing on this price decline here. You will get points where you get US equities and gold running in tandem to the upside. And that is what we're kind of seeing now. And that also is based upon quantitative easing, because when you think about the fact that when money is cheap for businesses to borrow and the interest rate is low, that causes stocks to rise. The fact that the dollar devalues at the same time causes gold to move in tandem with US equities.
Right.
So there are rare occasions when you'll see not only gold move higher, but you'll see equities move higher in tandem. And that occurs for the most part during periods of quantitative easing. And that is certainly what we're witnessing today.
So final question about the dollar then. So next year, can we expect QE to continue and maintain this relationship that you just discussed?
Yes and yes. The easiest way to look at it is, let's go to a dollar chart itself. And let's look at the long-term prospects of where we think it could go. Now, to give me these long-term numbers, I'm actually using a monthly chart. I'm starting down here when the dollar had a value of about 70. And what you can see is these various fib levels. And the fact of the matter is, even on a long-term monthly chart, because you can see it on dailies and weeklies, we broke through a key and critical area, which was right here. It occurred at about 91 on the dollar index. The fact that it's solidly below it means that the next target I'm looking at comes in at 87.21. And that's why I'm saying I think we'll see a further decline in the dollar throughout 2021. And that doesn't mean straight down. It's going to be a series of stair steps, but that's why I think we'll see the dollar continue to decline. And as I said, I believe that absolutely the Fed will continue an accommodative monetary policy until the economy recovers, one. And two, for the first time I have ever heard a chairman of the Federal Reserve said that they're now willing to let interest rates run hot because they had a key target rate of about 2%. So if inflation went to about 2%, they typically would ratchet up interest rates a quarter percent to kind of slow the inflation rate down. But now they're willing to let it grow hot in lieu of jobs, because they have a dual mandate, which is maximum performance and inflation at 2%. They're forgoing that 2% for maximum employment, and that's because we need it. We have such a large number of the American workforce. I believe it's roughly 1 out of 10 is unemployed. And so I see the dollar headed lower. I see the Fed continuing to do quantitative easing, and I see the Treasury Department adding more fiscal stimulus next year, because what we've done with this $900 billion package, simply put, is put a short-term Band-Aid on a long-term problem.
Okay.
In other words, they're going to need more aid.
All right, let's talk about silver now. Give us your 90-second take on silver, please. Is it going to outperform gold?
Well, I won't say outperform, but what I will tell you is that I believe, I'll give you the numbers of where I believe it could head to.
Sure.
And let me just go ahead and pull up our silver here. And to do that, once again, I'm simply going to use a Fibonacci extension. So you'll notice that we're incorporating the exact techniques we did with gold. And so what we're looking at is a excuse me, a wave one, which takes silver up to approximately 19. We get this short correction. Then we go into our wave three. So on the wave three, what we wanted to do was to see exactly where it could fall to. And to do that, you notice that my bottom number here is 50%. And what I'm going to do is to add the 61%. You notice that a new line has come in, and you notice how that correlates pretty much precisely with the lows that came in recently when we hit $22. And so what are we doing? We're basically looking at our wave three once again, which is just measuring the distance from here to here. We're then looking at the correction concluding at 22. And then we're saying that if the market moves up to a 6.1% extension, that only takes us to this recent top at 30. So my call for silver next year comes in at about $32, which is a 78% Fibonacci extension.
That's consistent with that's consistent with some of the other numbers I've been getting, 30s to potentially touching $40 an ounce next year. Okay, well, we've got a few minutes left. There's some good questions that have come in. This is more philosophical. I like this question. Why buy precious metals and commodities at all? Why not just buy a yielding asset like stocks? Just put your money in an index fund like the SPY that tracks the SP 500 and just park it there. Stocks have done quite well this year, regardless of a pandemic and a recession. Yeah.
The way you want to look at it is that typically a financial advisor, financial planner is going to recommend a balanced portfolio, which means that you have exposure in different sectors. The precious metal is really that safe haven component, but equities are always going to be a component. In the days where there was genuine interest yield that was more than 1/4% it was recommended that you had maybe 20 or 30% in bonds. Now, with interest rates as low as they are, bonds do not make the same kind of sense they did, say, 5 years ago. So to me, it's not a matter of one over the other. Do I get equities or do I get gold? It's a matter of the proper balance for your portfolio. Now, that should be based on you as an individual investor, meaning what is your risk tolerance? 1. 2, are you going to retire next year or in 30 years? 3, are you an aggressive trader or a conservative trader? What are you looking to get out of it? In other words, before you can tell or suggest a certain balancing of a portfolio, you have to understand the individual's goals and most importantly, their timeline. Because if you're 30 or 40 and you're got another 30 years where you're working, it's much easier to overcome a pretty massive drawdown. If the stock market sells off hard, you've got years to recover that equity. And if you look at stocks over time, it has been higher than it was 20 years ago, as far back as you can go, even with corrections. And so that would be my answer. It's how you balance your portfolio. Okay. Never look at it as one or the other, but what's the proper mix?
This question came in all caps, so this person is probably very worried.
Overall, I'm going to get ready. I'll get ready.
Overall crash coming soon. And look, I can see where the question is coming from. I had a few guests on calling for a market crash in the coming months to quarters. And recently an analyst told me that we've just reached a multi-year top in the equities. I'm talking about stocks right now. Possible crash in the stock market. Do you see that happening in 2021, Gary? If so, what could trigger it?
Well, there's a couple of parts to that. Paul Volcker put it best when he talked about interest rates and equity prices. He simply said, trees do not grow to the sky. They never have, they never will. And so the takeaway, obviously, from that statement is a market will move up and at some point it will be considered overbought and you will get sellers coming into the market. The second part of so could there be a correction next year? Absolutely, yes. At some point, I believe there will be. The key is this. We've seen the stock market hit multiple all-time record highs as we've seen an economic contraction, the likes of which we have never seen. And yet the stock market kept going up. Why? because the market sentiment wasn't on what they saw as today's picture. In other words, where they thought that stock value was worth, but what it will be worth a year down the road. And when you get an economy that continually contracts, and depending on how the current pandemic kind of runs its course, because there is finally light at the end of the tunnel, we're still not sure how far it is till we get out of the tunnel. But I have been absolutely amazed at how well equities have performed in light of the underlying fundamentals, which are showing severe economic contractions. That means a couple of things. One, quantitative easing is providing some help, and the aid packages are providing help. And for example, the travel sector is getting slammed because not many people want to go on a plane. I'm here in Hawaii, and when the pandemic hit in March, you could go down to Waikiki, which is kind of the tourist section of Honolulu, and it was a ghost town. And so, whereas you had a national unemployment rate that was high, we were up to 30 and 40% at certain points because the hotel workers were all on furlough. The restaurants that fed into that, it's always a chain itself, and all of the ancillary companies that fed off that tourism really got hit hard. They're just starting to come back.
Okay.
So to answer it, we could easily see the market correct at any point. And what would precipitate that is a new wrench in the wheel, so to speak. In other words, if the vaccine is not effective against this variation, that could really put some serious pressure on U.S. equities. But as a whole, the investment community is optimistic. They have been bidding up equities that are in the proper sector that do well. A company like Zoom, anything that was related to the work at home, they did exceptionally well. The airlines, the hotels, they're under extreme pressure, and the economic fallout is just beginning to be known. And that's one thing that we have to understand more than anything else. The pandemic will run its course. And the vaccine at some point, hopefully by the first or second quarter, will be available to the general public. Let's assume that it does have the 95% efficacy rate that these three pharmaceutical companies have found in their stage 3 trials, which is why the FDA granted emergency use. We could see a scenario in which we are out of the woods in terms of the pandemic, but now the waiter's going to hand us a bill in terms of the expenses it costs us to get there. Because a $3 trillion expenditure by the CARES Act, call it another trillion, I'll wind it up, from 900 billion to $1 trillion. So there's 4 trillion, and figure that they allocate another 2 or 3 trillion next year. That's going to give us the largest budget deficit in the history.
Okay, Gary, we have time for one more question. This is a good one. Gold-silver ratio. We haven't had time to discuss that. Very briefly, can you give us your outlook on the gold-silver ratio for 2021?
Well, let's see if we can.
Because I do know that you are bullish on both gold and silver, but I think this is more of a question as to which one will run its course more, right?
Right, and to do that, this is the gold-silver ratio on a daily chart. We could put it in line format to make it a little bit more visible to the viewers, but I think that they'll get the gist. We can see that this basic ratio has gone from 125 ounces of silver to equal 1 ounce of gold to its current pricing, where it takes 73 ounces of silver to buy 1 ounce of gold. So we have seen that contraction of the gold-silver ratio favoring silver. As long as silver outperforms gold on the way up, which it has been, and it will typically outperform gold on the way down, but when you look at the big picture, silver will have a bigger gain percentage-wise than gold. We'll continue to see this ratio narrow. It could go as low as 65, wow, maybe even 60. But that's my view.
Okay, wow, fantastic. Gary Wagner, I want to thank you so much for coming on the show today. First ever live webinar or interview, whatever the term you prefer to use. whatever the case may be, thank you so much. How did you feel for you?
It was great, and I think it's the Dave and Gary show. We've got such a good rapport as we go through the charts. You already know the next question as I'm going into something. So my hope is that the viewers gain actionable knowledge. In other words, gain some insight that will allow them to be better investors and traders in 2021. And on that note, I want to wish all those that observe Christmas a very Merry Christmas. And to all of our viewers, I wish them a blessed and happy New Year, because we just went through 2020, and I'm sure 2021 has got to be better than what we've just come out of.
Don't jinx it, Gary. Don't jinx it.
Okay, forget it. Knock on wood. But no, I just want to wish all of our viewers a blessed 2021.
I understand. Thank you very much. Yes, Merry Christmas and Happy Holidays to all. Happy New Year. If you're just tuning in now, you've missed a great show, but don't worry, we will put this up as a regular interview video on our YouTube page that you can watch and rewind. Just to recap, Gary Wagner, editor of the Gold Forecast, joined us today to give us his outlook. He is bullish on both gold and the silver prices. He anticipates this gold-silver ratio to go down to potentially 60, and he sees the economy recovering somewhat in 2021. He explains this much better than I can, so go ahead, rewind it, and watch the key moments. Thank you so much for watching and for submitting your questions. We'll be doing this again, so tune into Kitco.com for the latest announcements on when the next live interview will be. I'm David Lin. Happy holidays. Thank you for watching.
Thank you also.